Tax offsets. This is good because this is us getting money back from the government. So I'll just give a little bit of quick history. Back in the old days, and this is pre-2007, in fact, probably worth going back to the late 70s, early 80s, there was a tax legislation called 10B and 10BA, which basically said, if you invest in a film, we'll give you what they call an accelerated tax deduction. We'll give you a tax deduction more than 100%. So let's say you put $1 million in a film, they'd give you a tax deduction of 1.5 million, which was, it was done to basically, you know, kickstart the Australian film industry, which in the 70s was not very big and struggling. And so the government said, we'll set up this incentive. And you'll see if you look at the number of feature films being shot, like it goes from, you know, 5, 6, 7 up to 70, 80, 150 because of this tax deduction. Now, unfortunately, the tax deduction was abused in that you got the tax deduction when you made the investment. If the film never got made, you still got the tax deduction. So you got all these films with investments going on, but not getting made. And so they're all these basically rorts. So the government scaled back, they stopped giving accelerated deduction. You got back to 100% deduction, then it was harder to get. So back in 2007, the government said, all right, 10B, 10BA, it's not working very well. We're going to scrap it, cut 10B, 10BA, and we're going to introduce tax offsets, which is the producer's offset, the PDV, which is the post-digital and visual effects offset, and the location offset. So there are 3 main tax offsets. The producers, and you probably have read a fair bit about these already because they make up a large part of a lot of finance plans. But the producer's offset is basically a rebate you get off the government at the end of the production, where if you spent money making a film, they'll give you a percentage back. So for example, you make a feature film, that's a $1 million feature film, and you've got $1 million of qualifying production expenditure. You finish that film, you deliver it, it goes into cinemas because you've got a distributor. You then do your tax return and the government puts $400,000 back into your bank. So it's a tax offset. It comes in at the end of the production. So what a lot of people will go, oh, well, I'm making $1 million film. Can you please, they'll go to a cash flow and go, oh, I'm going to get 400,000 at the end of the production, but I need that money now to actually make the film. Can you lend me 350,000 now and I'll pay you back when I get the producer's offset back? And that's called cash flowing the producer's offset. There's lots of legislation about qualifying. You've got to have things like significant Australian content. So they look at who's making it, whether they're Australian, whether it's set in Australia, all that sort of stuff. But like if you've got writer, producer, director Australia and you're shooting a science fiction that's set in Mars, that should still be fine. Basically, it's set up so that people don't come in from overseas and try and access this because it's set up to support Australian films. So there's a whole lot of things you need to qualify. All the regulations changed on the 30th of June as to, you know, minimum spends and what can qualify and what can't qualify. And I think there'll probably be pretty sure there's a separate session on that. The legislation hasn't passed the government yet. So we're actually operating in a bit of a void in that the government said the changes to the producer's offset are effective 1st of July, but we don't have legislation to tell you what's in and what's out. But that's basically, it's a tax rebate. It's a cash tax rebate. So if you don't know the ATO any money, they put money in your account, and quite often people borrow against that to get a film made. The PDV offset is the post-digital and visual effects. So that's really set up for post-production, and it's really set up to mostly to attract, you know, a lot of the post visuals, say from Hollywood and places like that. So it's set up to try and attract a lot of work into Australia for the post-production houses. That's run by the Department of Creative Affairs or whatever. They change the name every 3 months down in Canberra. So you're applying to a different department. For the producer's offset, you're applying to Screen Australia. You can get a provisional certificate, which is like a pre-approval for your project. It is a fairly, there is a lot of compliance about applying for producer's offset. They can ask for like up to 60 documents, ask to see all your agreements, ask to see your invoices, review your general ledger. There's a lot of work involved in a producer's offset application, but if you're getting 40% back, then that's pretty good. PDV is fairly specialized for the post-production houses, but basically, again, you're for the post-spend, and it can apply to animation as well. For post-spend, you're getting 30% back, which is pretty good. And the location offset is really set. That's really the incentive for the big Hollywood production. So you've got to be like over $15 million to get the location offset. It's a fixed amount, so it really mostly only applies to the Marvel and the people coming in. Just now, moving on to investment. As I've mentioned, there is no tax deduction for investment in a film. So if somebody comes in and goes, I'm investing in your film, here's $1 million, you go, great, thank you. And they go, can I get a tax deduction? And you have to go, I'm sorry, no, there is no tax deduction on investing in a film. In addition, if they give you $1 million, you give them an invoice for 1.1 million because you're registered for GST. You're a production company. This is how you earn income. That's income for your production company. So you actually have to charge them GST. So if they've given you $1 million, you give them an invoice of $1 million with GST on it. So they actually end up with $909,000 worth of equity or something like that. Having said that, there is, if you give the investor a share of copyright, copyright is an intangible asset, and you can deduct intangible assets over their effective useful life, same way you depreciate an asset. So you can get an investor a income tax deduction if they get a share of copyright. But let's say they give you $1 million and the film is going to make money for 5 years, they might get a deduction of, they might depreciate that over 5 years, so they get a deduction of $200,000 a year for 5 years. So it's not a upfront deduction; it's a deduction over the life of the film. But it is a way of giving investors, some benefit, tax benefit for investing in a film. You've got to look at the downside of giving copyright to investors, and that's more a question for your lawyers and what rights are you letting them have when you give them copyright. Most of the time, investors don't do much with their copyright apart from claiming a tax deduction. But that's, again, starting to get into a technical area, and you should be chatting to a media tax accountant if you're starting to look at things like copyright and media lawyers and things like that. The other one I was just going to mention quickly is the Documentary Australia Fund. If you have a documentary, there is effectively a charity set up called the Documentary Australia Fund, and your investor can actually give that money, donate that money to the Documentary Australia Fund. They take a cut, I think it's 5%, and they then invest in your film, and that way the investor does get a tax deduction. It doesn't work for dramas, only works for certain documentaries. They have to have like a social impact and that sort of thing. But if you are a documentary maker and you're not familiar with the Documentary Australia Fund, it's definitely worth looking at.